Well, good day, everybody. We're here at the Rule Symposium on the cruise for attendees. I'm here with Adrian, and I thought I'd get a chance to ask him a couple of questions about the sentiment on the conference. So, Adrian, how are you finding things so far?
Yeah, I would say we've got to remember, first of all, that most of the people attending this conference are people who've been in the gold market for a while. First of all, they've seen the ups and downs, and secondly, of course, they've got some pretty good profits despite the recent decline. So I would say the sentiment generally is optimistic, cautiously optimistic, but perhaps with an emphasis on the optimistic. The biggest question people have now is this a good time to be buying? Is this a good time to be adding? But certainly people are not panicking. And, that's contrasting with the broader sector, which you would expect, because these are people interested in gold. But when you look at the broader market, the sentiment just simply couldn't be weaker. You've got GLD, the physical ETF, GDX, equity ETF, which are seeing massive ongoing outflows of people selling gold and selling the mining stocks in ever increasing amounts. The Bull Bear Sentiment Index, they do these things on every market and so on. They do it on the stock market, on foreign markets, on the dollar and so on. The dollar, incidentally, is overwhelmingly bullish right now, over 80% bullish, which is quite lopsided. But the sentiment index on gold miners is down at 7% bullish. That is just an outrageously low number. I mean, I've been looking at these things for 50 years. You rarely see anything get under 20%. So to be at 7% bullish is really quite extraordinary. And actually, one day just 2 weeks ago, we actually had a zero bullish reading, zero. I like to joke that I wasn't in the sample that they asked, because it wouldn't have been zero if they'd have asked me. But the sentiment is extraordinarily weak.
What I find interesting is a year ago the gold price was a lot lower than it is today, but I think the average sentiment is a lot worse because so many people jumped in at the end of last year and they just got burnt. They finally dipped their toe in after hearing their friends talk about gold, and they finally go in and they just get punched.
No, you're right, but of course, Mark, even in December and January, we were not seeing huge amounts of money flow in. We saw a lot of money go into silver. But into gold, we really didn't see huge amounts come into gold or into gold equities. We saw more, of course. It was positive, not negative. But even then, it was remarkable to me how subdued the sort of interest in gold was. I think the plain fact is people, by and large, are simply not interested in gold. But, it's a perfect setup for me when the stocks are down 40%, when the valuations are extraordinarily low right now. Scotia just did a study of the top mining stocks on various valuation metrics over the last 50, was it, or 60 years. And on every single metric they came up with, right now today in 2026, we are in the lowest 25 percentile, the lowest quartile of valuation. I'm talking about valuations, not stocks. Now, when the gold price is 4,000 and the all-in sustaining cost of 1,350, the margins are extraordinarily strong. Other than last year, these are the best margins we've ever had in this business. And so to have this lack of interest is really quite astonishing. So with low prices, low valuations, and weak sentiment, as a contrarian, that is just a perfect setup for gold.
And the market is pricing in Warsh to come in and raise interest rates, be the hero that both stops inflation but keeps things ticking along. I mean, how much does that get priced into the market from here? Do you think gold drops below 4,000, or is this going to hold? What do you think happens from here?
Well, this is very short term, and by the time people listen to it,
that's a fair
may
point.
Be different. But I think there's a good possibility that we get a test of a recent low and gold fails at that test. And if it fails at that test, I think it'll be a quick drop down to 3,600. The stocks, of course, will fall much more than that. Now, I mean, you can never predict the future. And particularly, I mean, who knows what will happen this week, next week. So much depends on the war and when that ends. But I think there's a reasonable possibility of a further decline, which means that I would put some money to work now because the valuations are very compelling, but I would keep some money on the sidelines in case there's a further drop.
Okay. And what do you think happens to silver in that environment if gold breaks below?
Well, silver goes down further, doesn't it?
Right.
I mean, silver's already
fallen quite a bit.
Fallen more than gold. I mean, I would think that we could get to the high 40s. You know, we could break 50, we could be at 47, 48, and that would be, again, a very compelling price to be buying silver. The thing about silver, of course, is that there's much more retail interest in silver. So if you looked at December and January, you really did see floods of money pouring into the silver ETFs. The retail component for silver is a much larger force than the retail component for gold. And most retail, it tends to be a little more
easily in and easily out.
Yeah, I was going to say skittish. Skittish isn't the right word, but it moves in and out quicker. And so that's why silver's more volatile, both on the upside and one of the reasons, both on the upside and the downside. But yeah, I mean, I think if we see another drop in gold and silver, that's going to be a very, very compelling opportunity. You mentioned Warsh, and, you know, I have to say I was pleasantly surprised by Warsh in many ways. We're not going to discuss him today. But the reality is, whatever he wants to do, there are constraints. There are political constraints, and there's also economic constraints. I mean, you simply cannot raise rates too fast with the credit markets, private credit markets, the way they are in the U.S. We've already got a problem in the private credit. You raise interest rates, and some of those problems, you know, come to the surface and can't be ignored. So there's a limit of how rapidly you can raise rates. Remember, you compare where we are today with where we are with Volcker coming in. I don't actually have the number off the top of my head, I'm really sorry, but I think when Paul Volcker came in at the end of the 1970s, the debt to GDP was about 55, 57%. It's now at about 126%. That means that you simply cannot raise rates the way that Paul Volcker did without causing very, very significant damage to the economy, to you know, employment and everything else. You know, Volcker caused a deep recession, but it was a recession that we could get out of. This would cause something much more damaging.
Yeah, so what happens? I mean, in the 70s, you had the introduction of the petrodollar to create demand for dollars outside of the U.S. You had them raising interest rates to an amount that was higher than inflation. I mean, it looks like petrodollar systems, if not completely broken, it's breaking down. Interest rates going up to meaningfully above inflation is, you know, impossible without defaulting on the debt. So what happens? How does the government control inflation?
Well, you mentioned the petrodollar, which was a new way of getting demand for dollar. We're seeing, I mean, Scott Besson, the Treasury Secretary, and Kevin Walsh, who know each other, Fed Chairman, I think they're being quite creative in trying to find new sources of demand for the dollar. Because as we know, foreign institutions have been backing away from the dollar for several years now, not just central banks, but other things. Japanese pension funds are now moving away from the dollar, not for political reasons, but just because interest rates in Japan are going up. So the differential between the US and the yen is less, but there's a lot of there's a lot of people backing away from the dollar for political reasons. So they're trying to create new demand, new sources of demand for treasuries. The U.S. stablecoin, of course, and you know, with the passage of the Genius Act, that is meant to encourage new dollar stablecoins, which will be a new demand for dollar. There's talk about increasing reserve requirements for the banks, so the banks have to hold more money on reserve in treasuries. These are all ways of creating new demand for the dollar. I think they're being very creative. Given, I'm not excusing anyone, but given where they were, given the situation when they came in, I think, they're doing what they have to do. But these are sort of tinkering at the edges.
Yep.
I can't see either of those two things that I just mentioned really being complete game changers in demand for the dollar. But I guess you could say, given where we are, any new demand is good, right? I wouldn't be surprised if we see, the U.S. government, with the current administration, pressure foreign countries, to put more reserves into the dollar. We'll do a good trade deal with you if you buy more of our treasuries. So all of these things, will help get demand for the dollar. But the plain fact is that the issuance is just too much. We got $10 trillion of issuance this year, $10 trillion. And, China's not buying, Japan's not buying, Russia's not buying, obviously. I mean, the erstwhile big buyers are just not buying. So I think interest rates have to move up, as they already have, in the market. I'm not saying the Fed has to raise rates, but the long bond yields or the bond yields just have to move up to create that demand. But the ultimate thing, of course, is that the US, you essentially default through inflation. You default by making what you pay back worth less than what you borrowed.
Do you think that, obviously some investors who see this problem coming, they're buying gold, they're buying foreign stocks, they're buying resource stocks. Do you think that investors should start to look at owning foreign currencies as well for the more conservative portion of their portfolio?
Yeah, no, definitely. We really haven't seen that. We saw a lot of that in the 70s, of course.
The dollar crashed, 75% against the Swiss franc?
So we saw a lot of it back then.
Yeah.
We really haven't seen that yet. But I think once the war is over and the safe haven premium for the war goes away, remember the dollar was falling last year. The dollar was steadily falling throughout the year, and then it only recovered when the war started and we got the safe haven premium. I think, you get another year of a decline in the dollar, people will start to look for putting money in foreign currencies. Now, I think if a person wants to hold cash, I would definitely be holding it in foreign currencies right now. Short-term treasuries, short-term bills and notes in foreign currencies, you're not going to get much of a yield. But I think you're going to first of all, you're going to diversify away from the dollar, but you're also going to protect yourself against a decline in the dollar. That's if someone is just looking to hold cash. And as you say, we saw that in the 70s.
Now, I think President Trump might be the best salesman the world's ever seen, so it's not surprising that his administration is doing a relatively good job of selling U.S. treasuries.
Yeah.
Do you think that flows through to the next administration? Obviously, we don't know who they're going to be, but is this a one and done, or do you think they pull another?
Well, certainly the problems are nothing to do with the current administration. They didn't start with the current administration. They won't end with the current administration. It's difficult to say. The U.S. stable coins is going to continue. That's going to continue through. But I think we basically have a fundamental structural problem where we have too much debt and we don't have enough demand for it. The problem is when you're a reserve currency, the French president Valéry Giscard d'Estaing called it the exorbitant privilege. And it's a privilege that allows the country, in this case the US, previously Britain, to issue more currency to increase its own money supply much more rapidly than is justified by its own economy. And the US, in this case of the US, since 71, since the US finally broke with gold, the US has created far more money than is justified by its own economic growth. But it could do that because it knew foreigners would buy it. and its official foreigners, central banks and so on. It's also private foreigners. We've talked about this privately. I don't know if we've talked about it, but you know, if you go to Colombia or Bogota and you want to buy some drugs on the corner and you give them US dollars, they'll take them. There's no hesitation.
Are you speaking from experience in Puerto Rico, or?
But if you offer them British pounds or Canadian dollars, they'll think it's just funny money. But if you offer US dollars, they'll take them. And this is true around the world. You go to Romania and you say to the taxi driver, haven't changed my money, I have no loo, will you take dollars? Everybody will take dollars, everybody. That is the exorbitant privilege of being a reserve currency. And what happens to that, let's just mention the drug dealer. At the end of a week, when he counts up all his money, he's got a stash of US dollars and a stash of Colombian pesos. He puts the pesos in the bank
and
he saves the dollars. But at some point, and we saw this in Britain very clearly, at some point people lose confidence in that money and its purchasing power, and that money starts to come back to the US. That drug dealer goes to the bank with his dollars and say, here's my dollars, I want to change them for pesos. And those dollars flow through the banking system back to the US. And so all the money that the all the excess money that the US has created over 50, or really over 70 years.
Yeah, if you count the Bretton Woods system, I mean, it
starts coming back into the country. And we saw this with Britain at the end of the Second World War, 1945. The pound was worth 5 to 1, right? You could get $5 for £1. Within 3 decades, it was 1 to 1. Until Margaret Thatcher came in, it was 1 to 1. So the decline, that's an incredibly rapid decline. And what did that do? That's the exchange rate, because there was no longer a demand for dollars. So what did that do for the economy? Well, we had massive unemployment. We had a very stagnant economy. I mean, Britain in the 50s and 60s was, we just didn't have the economic growth at all. I remember as a young kid sitting on the TV and we were enthralled when we watched I Love Lucy. Not because we thought it was so funny, but because of all the gadgets she has. Look, she's got a washing machine. Wow. You just put the stuff in the washing machine and it goes. And, this was all a marvel to us. And this is Britain we're talking about, not, Kazakhstan or something. No offense to any Kazakh listeners. And so in the end, in the 1960s, Britain went cap in hand to the World Bank for a loan. And that's what happens when you lose that reserve currency status. All of that excess money just comes flooding back. That's going to happen to the US. And these things happen, as Hemingway said about going bankrupt, these things happen slowly at first and then suddenly. And, I think it's inevitable. Will it be 2 years, 5 years, 10 years, 20 years? I don't know. But it'll happen slowly and then it'll start to happen rapidly. And as we know already, central banks are losing confidence in the dollar. We've talked about this before, but in the year 2000, something like 78% of foreign reserves of central banks were held in the dollar. Now it's down to 50%. That is, for central banks who are very slow moving, right? They are strategic and slow moving. That is just an enormous shift.
They're cheering you on, Adrian.
Anyway.
All right. I think that's probably all we have time for. It's getting a bit dark here. Thanks for joining us, everybody, and we'll see if we can throw a few more videos your way while we're here.
Thank
Cheers.
you. Okay,
Bye-bye.
Thank you, everyone.